dividends are a way of giving investors a return on their investment, regardless of the share price. And it's also an incentive to invest in a particular company. Now, many investors, for example, hold on to blue chip stocks, which don't necessarily appreciate so much in share price value, but do pay out regular dividends. Now, there's some ground rules, though. The payout comes out of a company's earnings, and the amount is decided by the company's board of directors. And in order for a company to pay a dividend, it has to be secure, stable, profitable, and generate free cash flow. Now, free cash flow is considered a gauge of a company's health and its ability to make payments and, of course, grow the business. Now, dividends from the world's listed companies actually topped the $1 trillion mark for the first time in 2003, and that's according to research by Henderson Global Investors. Global dividend value has risen 43% from $700 billion since 2009. Now, emerging markets, including China, actually saw triple-digit growth in dividends, and that's the fastest shareholder payout growth in the past 4 years. So pretty impressive data there. Now, over a third of all dividends were paid by U.S.-listed companies, followed by European-listed companies. Rising dividends are, of course, a sign that people are looking for income from stocks instead of bonds. And a lot of that lately is thanks to the Federal Reserve's low interest rates and that bond buying program. So to discuss all things dividends and markets, we're now joined by Kennon, Chief Executive Officer at Clear Harbor Asset Management. Aaron, thanks for joining us this evening. Good to have you.
It's nice to be here.
So we saw dividend payouts to shareholders around the world reaching over $1 trillion last year. Why is that significant? What does that mean?
Right. Well, we've certainly come a long way, Michelle, since the bottom of the financial crisis in 2009, where we clearly had significant depressed levels in both the stock market, but ultimately in earnings, particularly in the financial sector. And if you take a look at the MSCI Global World Equity Index, just over the last 5 years, the index itself has risen 45%, and dividends for the MSCI World Index have risen 43%. So a great deal of the dividend growth that we're seeing is a function of earnings growth off the bottom of a very low base in the financial crisis.
So that shows, one would think, overall economic health, because if a company is doing well, it's generating revenue, it has higher income, it's then able to give a slice of that action to its shareholders. That's essentially what a dividend is. So does this bode well then for the overall global economy?
Well, I think it does. I mean, I think that there are a couple of things to consider, and you alluded to one earlier, which is quantitative easing at a global level. Certainly in the United States, we've had a huge expansion of the Federal Reserve's balance sheet, and we're seeing the same a bit in Europe as well as in places like Japan. And due to quantitative easing, you have investors looking for income away from their traditional locations of sovereign interest rates and moving into the equity market. So to a great extent, we're noticing dividend demand, and corporations are actually reacting to that.
Right. So people wanting to generate income. So for our viewers, explain what that means. If you'd have a bond ordinarily, then you'd get a payout from that bond. But because interest rates are so low, people are looking to companies.
That's right.
Which then pay them quarterly.
That's right. So corporations hopefully generate earnings, and corporations that are governing their cash flows correctly hopefully have confidence in their future cash flows and therefore have a tendency to pay out dividends. There are some companies, particularly some sectors like technology, that have a tendency not to pay out dividends because they're fast growing and they feel as though they can allocate capital to higher growth sectors without paying out that dividend. But we've certainly seen activism.
And Apple is a big example of that.
That's right.
Apple hoarding onto its cash, saying, hey, we need this for future growth, rather than paying out to shareholders. So I want to talk about the role of activist investors now that you've mentioned Apple, like Carl Icahn, for example. Are these companies paying dividends because of good corporate governance, or because you've got majority shareholders saying, hey, you guys are making all this money, we want our slice of the pie?
Well, I certainly believe activism has played a very positive role, particularly in corporate America, to some extent in Europe. You look at someone like Carl Icahn, he sort of pushed on Apple, maybe nudged Apple a bit. They were probably moving in the right direction, but he wanted to accelerate the process of special dividend payments. Not consistent dividend payments, but increasing various special dividend payments. And it seems to have worked relatively well.
So which sectors would you say are most reliable in consistently paying out solid dividends?
Well, from a U.S. perspective, and even to some extent from a global perspective, the utility sector is certainly an area. We focus at Clear Harbor Asset Management on natural gas and water utilities, less on the electric utilities and the nuclear utilities as well. They've been consistent multi-decade dividend payers. Certainly the banks have historically been consistent dividend payers as well. Of course, the financial crisis sort of tested that thesis, but now we're back and seeing most banks, at least in the United States and even abroad, paying consistent dividends.
Now, one of the interesting things that we've seen is a big increase in global dividend payouts in emerging markets, particularly in China.
Right. And what we've noticed, too, as it relates to China, is that in the mid-cap and large-cap sector, we're certainly seeing healthy dividend payouts. The area, going back to your point about activism, that we've been a bit concerned about in China is in the small-cap arena, where we feel as though corporate governance is sort of lacking. A lot of corporate managers in the small-cap Chinese area that we've looked at have sort of refused to pay dividends, or if you look at the cash on their balance sheet, it's sometimes in excess of their entire stock price. And so we ask, you know, shareholders need to have a place at the table. We believe that shareholders need to be partners with managers, that they're part owners of companies, and that in that small cap segment of the Chinese marketplace, there's a huge opportunity for managers of these companies to recognize that. We think it'll ultimately be reflected positively in their share prices.
Okay, so a lot more room for activism in the Chinese markets.
Absolutely, we hope so.
Okay, we're going to have to leave it there. Thank you so much, though. Kennon, Chief Executive Officer at Clear Harbor Asset Management.